All right, let's dive into something that's absolutely fundamental for any business, whether you're a huge corporation or just starting out in your garage. We're going to talk about keeping your financial world from, completely spinning out of control. And it all starts with one big question. I mean, this is the question, right? It's the one that can really keep you up at night. You're tracking every sale, every expense, all the money coming in and going out. But how do you really know that all those numbers, day in and day out, actually add up? Is there a sneaky little error hiding somewhere in your books?
Well, the good news is you don't have to just cross your fingers and hope for the best. There's a system for this, a foundational check. And that's exactly what we're going to break down. The very first, crucial checkpoint for your financial accuracy.
So let's get right to it. What is this thing? It's called a trial balance, and in the whole accounting process, it comes right after you've recorded all your transactions in the journal and moved them over to the ledger.
Now, the most important words here are statement and arithmetical accuracy. This isn't an account itself. It's more like a report card, a snapshot of your ledger on one specific day that asks a very simple question. Do the numbers actually add up? So, what's it really for? Well, it's got three main jobs. First, and most obviously, it's a math check. Did we mess up any of the simple addition or subtraction along the way? Second, this thing is the bedrock for all your big financial statements, like your profit and loss and your balance sheet. If the trial balance is off, those reports are going to be useless. And third, it's an amazing summary. You get this great bird's eye view of everything without having to dig through page after page of your ledger.
Okay, so it checks for balance, but how does it do that? Well, the magic isn't really in the trial balance itself, it's in the brilliant accounting system that it's built on top of.
This is the absolute heart of what's called the double entry system. The idea is that for every single financial action, there's an equal and opposite reaction. If cash comes into your business, something else has to account for where it came from. If you spend cash, you have to show what you got for it. That scale, it must always stay perfectly level.
And here's basically how that scale is organized. On one side, the debit side, you've got your assets, expenses, and losses. Think of this as the stuff you own and the money you spend. On the other side, the credit side, you have your liabilities, income, and capital. That's kind of like the money you owe and the money you earn.
So let's look at a really simple example to see it in action. For Anarata traders here, we've just lumped all the debit type accounts together, things like purchases and expenses, and they total 292,500 rupees. Then we've grouped all the credit type accounts, like capital and sales, and what do you know? They also total 292,500 rupees. See? The scale is perfectly balanced. That's the magic number. That 292,500 on both sides, it tells us that mathematically, everything we've recorded is in agreement. The debits equal the credits. Whew! It's that moment of relief, or maybe it isn't.
And here's where the story takes a little twist. Because I've got to tell you, a perfectly balanced trial balance could still be hiding some major mistakes.
I mean, this is the million-dollar question, isn't it? You see those two identical numbers at the bottom of the page, and you just want to breathe a huge sigh of relief. But should you? Does that perfect agreement automatically mean perfect accuracy?
And the answer, maybe surprisingly, is no. A trial balance is fantastic at catching basic arithmetic errors, but, and this is so important, it is not conclusive proof of accuracy. There are a few types of errors that are completely invisible to it because they don't actually upset that perfect debit-credit balance.
These are the sneaky ones, the errors of balance. Just think about it for a second. If you completely forget to record a sale, well, both the debit and the credit are missing, so the totals still match. If you accidentally write a 1,000 rupee purchase as 100 rupees in both columns, again, it still balances. Or what if you correctly record a 500 rupee expense, but you put it under office supplies instead of marketing? The total number is right, but it's in the wrong place. A trial balance won't catch any of that.
So, where does that leave us? What's the bottom line here? How are you supposed to think about the trial balance now? If you only remember one thing from all of this, let it be this right here. A trial balance is a necessary first step. It confirms your math is right, but it does not confirm that your accounting is right.
The best way to look at it is as a vital, foundational health check. It's the first thing you do to make sure the heart of your accounting system is beating correctly. It's an absolutely indispensable tool that sets the stage for creating financial reports you can actually trust. It just isn't the only tool you're going to need.
And you know, that really leaves us with a final thought to chew on.
If the trial balance is just the first checkpoint, what comes next? What other checks and balances and reviews do you need to make sure your business gets a truly clean bill of financial health? Something to think about. Thanks for tuning in.